What if I told you the biggest risk in Arizona right now isn't buying too early? It's buying in the wrong city. For the last 3 years, Arizona was one of the hottest real estate markets in America. People poured in from California. Remote workers cashed out and paid cash. Builders couldn't pour foundations fast enough. And prices? They didn't just rise. They exploded. But here's the part almost no one talks about. Inventory is climbing. Price cuts are spreading. Homes are sitting longer and longer. The overheated boom is cooling, and in some cities, it's cooling faster than you might expect. Tonight, we're counting down the top 10 Arizona cities where home prices could see the biggest corrections heading into 2026. And here's the promise. By the time we reach #5, you'll understand why one city that seemed safe is suddenly at risk. And when we get to #1, it could change the way you think about Arizona real estate forever. But this isn't fear-mongering, not hype. Just data, market trends, and the real story behind the Arizona housing market crash 2026 conversation. Every city on this list has a story. Some shocking, some subtle. But each one reveals a pattern most buyers and investors are missing. So here's the deal. Watch closely, because every entry is connected. A clue from number 10 will help you understand why number 5 and number 1 matter more than you think. Before we start the countdown, hit subscribe if you want the clearest, no-nonsense breakdowns of Arizona real estate market trends, smart investing moves, and where the opportunities and risks really lie in 2026. Ready? Let's start with number 10. And trust me, you're going to want to see why this quiet city might actually be hiding a big clue for what's coming next. Number 10, Yuma. The border boom that could be losing steam. Population, 100,000. Yuma isn't flashy. It's practical. Military presence. Agriculture. Border economy. But during the last boom, something unexpected happened. Phoenix prices skyrocketed. Investors looked for cheaper alternatives. Out-of-state buyers discovered Yuma. Suddenly, homes were selling for 35 to 45% more than just a couple of years ago. Why did it overheat? Low interest rates made even modest homes look affordable. Investors bought multiple properties for rentals. Remote workers searched for space and lower cost of living. And yet, here's the catch. Inventory is slowly rising. Homes are sitting longer on the market. Price cuts are creeping in. Local incomes haven't kept pace. So, is Yuma about to crash? Not exactly. More like a gentle cooling. But the signals are clear. If buyers hesitate or rates rise further, the market could soften faster than expected. And speaking of surprising shifts, number 9 is even more subtle, but the signs are impossible to ignore. Number 9, Sierra Vista. Military stability meets investor exit risk. Population, 45,000. Sierra Vista is anchored by Fort Huachuca. That stability once made it a safe harbor for housing. Then remote workers and investors arrived, drawn by lower prices and hidden potential. Homes shot up 30 to 40% in under 2 years. But here's the twist. When momentum fades, investors often exit first. That's exactly what we're seeing now. More homes listed, longer selling timelines, buyers negotiating harder. Builders didn't overbuild, so the downside is limited. But the psychological shift is telling. Even strong markets aren't immune to investor behavior. And the city after this? It's all about speculation meeting overdevelopment. Wait until you see number 8. Number 8, Casa Grande. The speculative growth play. Population, 60,000. Casa Grande sits between Phoenix and Tucson. Its location made it irresistible for investors. During the boom, prices jumped 50% plus, fueled by speculative buying, rapid development of master-planned communities, out-of-state buyers chasing value. But here's the warning sign. Builders kept up with demand, sometimes overbuilding. Inventory is now stacking up. Incentives are being offered to sell quickly. And when builders compete against resale homes, guess what happens? Prices start to compress quietly. Casa Grande may not be headline news, but it illustrates exactly how overheated suburban markets begin to cool. And if you thought that was subtle, wait until you see number 7. It's an edge of metro city where growth feels unstoppable, yet danger is lurking. Number 7, Buckeye. Edge of metro expansion risk. Population 110,000 plus. Buckeye exploded during the pandemic. Cheap land, endless new builds, sprawling master-planned communities. Some neighborhoods saw prices rise 60% in just a couple of years. Why it overheated? Massive new construction, investor purchases, Phoenix spillover, remote worker migration. But edge markets are fragile. Rising commute times, gas costs, and high interest rates expose cracks. Inventory is climbing faster than central Phoenix. Builders are still active, which adds downward pressure. And here's the hint. Number 6 is completely different. It's luxury-driven, scenic, and rate-sensitive. The way it cools will surprise you. Number 6, Sedona. Luxury momentum meets economic sensitivity. Population 10,000. Sedona isn't your typical market. It's scenic, lifestyle-driven, and relies heavily on tourism. During the pandemic, wealthy remote workers poured in. Prices, in some luxury segments, jumped 50 to 70%. But here's the key. Luxury buyers are extremely rate-sensitive. Jumbo loans, second home purchases, all slow when rates rise. Now, inventory is sitting longer. Price reductions are creeping in. Buyers have negotiation power they didn't have 2 years ago. Sedona isn't overbuilt. Land constraints protect it. But its demand elasticity makes it vulnerable in ways smaller, cheaper markets aren't. And now, we're about to hit number 5. This is one that will surprise you. A city that looked safe is now under pressure. And understanding why number 5 behaves this way gives you a huge clue about the trends in number 1. Number 5, Tucson. The quiet surge that outpaced its income base. Population 550,000. Tucson was once considered the affordable alternative to Phoenix. That label fueled a quiet migration wave. During the boom, prices shot up 45 to 55%, faster than local incomes could keep up. Out-of-state buyers and investors flocked in, chasing both space and value. But here's the twist you need to watch. Inventory is increasing steadily. Sellers are now reducing prices. Days on market are stretching. Builders expanded in outer areas, and investor-owned rentals are now competing directly with new homes. This is the city where affordability truly matters. If wages don't catch up, the gap between local income and home prices could push a more significant correction. And here's the micro loop. Tucson's story hints at what's coming in number 1. The faster a market grew relative to fundamentals, the more fragile it can be. And number 1 is the ultimate example. So, keep that in mind while we move to hashtag 4, because the next city is all about suburban saturation and how too much of a good thing can quietly shift a market. Number 4, Goodyear. Suburban saturation. Population 100,000. Goodyear's growth has been tied to the Phoenix metro expansion. New communities, logistics jobs, and healthcare growth made it a magnet for families and investors. During the boom, prices jumped around 55% in peak years. Builders responded aggressively. But here's the catch. When too many similar homes flood the market at once, even strong demand can't hold prices. Signs of cooling. More homes listed than buyers. Builder incentives increasing. Slower absorption rates. Goodyear isn't collapsing, far from it. But it's a classic case of suburban saturation, showing how rapid growth can quietly set the stage for a softening market. And that brings us to hashtag 3, a city where new construction pressure is creating hidden risk. Wait until you see how builders there are silently influencing resale pricing. Number 3, Queen Creek, the new construction pressure cooker. Population 75,000 plus and rising. Queen Creek became a magnet for families during the pandemic. Brand new homes, good schools, suburban lifestyle. Prices soared over 60% in some neighborhoods. Builders doubled down, adding incentive programs, closing credits, and upgrade packages to move inventory quickly. Here's the loop. When builders and resale sellers compete, prices naturally compress. That's exactly what's happening in Queen Creek. Signs of cooling, increasing new construction inventory, price incentives for buyers, resale homes adjusting downward to stay competitive. It's subtle, but if you watch carefully, you can see the market pressure building, a precursor to the bigger cities coming next. Number 2 is even more dramatic, and here's the micro hook. Luxury demand can shift fast when economic factors change, and Scottsdale is a prime example. Number 2, Scottsdale. Luxury cycles are not linear. Population 240,000. Scottsdale's story is all about wealth-driven volatility. High-income migration, cash buyers, and investor short-term rentals fueled a boom. Some segments saw 70% plus price increases. Luxury markets behave differently. They're highly sensitive to interest rates and discretionary income. Now, luxury listings are staying on the market longer. More price reductions are appearing. Short-term rental regulations are tightening. Scottsdale has resilience. But here's the curiosity loop. When the most affluent buyers hesitate, the ripple effect hits neighboring cities. And that sets the stage perfectly for number 1, the epicenter of the boom, where the fastest growth meets the highest risk. Number 1, Phoenix, the epicenter of the boom. Population 1.6 plus million. Phoenix isn't just a city. It's ground zero for Arizona's housing surge. Remote workers, tech expansion, institutional investors, build-to-rent communities. Some neighborhoods saw prices rise 60 to 75% in just a couple of years. And that's exactly why number 1 is the city you cannot ignore. Today, inventory is rising. Builders remain active. Investor purchases have slowed. Affordability has tightened dramatically. Here's the emotional payoff. Phoenix didn't overheat because it's weak. It overheated because it grew too fast, too high, too hot. And now, the market is normalizing. Think of it like this. A market moving from 0 to 100 in 3 years has to slow down at some point. And the cities we counted down, from Yuma to Scottsdale, are all part of that same cooling story. The Arizona home price forecast for Phoenix signals normalization, but after a 70% surge, it can feel dramatic. And the loop tie-in? Remember Tucson at number 5. A similar pattern emerges on a smaller scale. Watch number 1 carefully, and you'll see the same forces at play, just amplified. OUTRO, the bigger picture. So is Arizona facing a crash or a correction? The truth. Housing moves in cycles. Boom. Plateau. Adjustment. Stability. Some cities may see mild cooling. Others could experience deeper corrections if inventory climbs and demand softens. The key takeaway. Arizona real estate investment risks in 2026 are hyperlocal. The city you choose now is more important than ever. Here's a question for you. Which city surprised you most on this list? And do you think Phoenix's peak growth makes it the most fragile or still the most promising? Drop your thoughts in the comments. And if you want the next breakdown, covering the top 10 Arizona cities that could outperform in 2026, hit subscribe. Because in this market, information is leverage and the cycle is already shifting.